On behalf of our team at HBK, I'd like to welcome you to end-of-year tax planning for manufacturing companies with HBK Manufacturing Solutions. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you'd like to submit a question to our panel, please use the question box in the GoToWebinar control bar. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you'll be prompted to complete a survey and provide us with feedback on the presentation. For more information and insights, please visit our manufacturing section of our Insights page at hbkcpa.com/insights. At this time, I'd like to turn it over to Amy.
Hi everybody. This isn't Amy. This is Jim DeCenzo. I am, for those of you who are not familiar with me, I am on the screen now, it looks like. I am a principal here, and I am the National Director of HBK Manufacturing Solutions. And with Amy, this is the latest in a long line of webinars that we have put together geared specifically towards manufacturing companies. And I think today it's going to be a little bit of a different setup. It's more interactive and hopefully more interactive. So if you have questions, by all means, submit them. We are going to be addressing some questions that have come up over the course of time as it relates to year-end tax planning. And this is a big year for year-end tax planning for manufacturers. So we are going to address some items that are of relevance as we approach the end of the year, and also going to be talking some about Build Back Better and some pending tax legislation and how that may affect manufacturers and ways that you could get ahead of it and do some planning. So as we jump into it, I just encourage everybody to contact your HBK representative as we approach the end of the year to do some tax planning, because this is really could be an impactful year in a number of ways, and we'll discuss some of them today. But one of the things that we like to do is the planning. That's where we add the most value. Anybody can do a tax return after the end of the year, but the planning up front is where the real value is added and hopefully money is saved. So with that, we are going to jump right into the questions that have been submitted. So I want to introduce those. Before we do that, I just want to introduce the other panelists here today. Nick Demetrius is a principal in our tax advisory group and has a lot of experience working with manufacturing companies. Donald Trummer is a senior manager and a tax specialist for HBK Manufacturing, and of course, last but not least is Amy Reinhold. Amy's a senior manager here in Youngstown, and she works exclusively in the HBK Manufacturing Solutions group as a consultant. And Amy's able to assist companies in a lot of the non-traditional, outside of the tax and accounting arenas. Amy's been a real asset to us in consulting, strategic planning, a lot of the, again, areas where we can really add value. So I guess we'll move right into the panel overview. And since this qualifies for CPE, here's our first poll question. So do you need CPE credit for today's presentation? Should be a pretty simple yes or no. So after that comes off the screen, we are going to jump into our first panel question. And again, I stress this is meant to be interactive, so feel free to submit any questions as they may arise as we're talking, and we'll address them either at that time or at the end of the session. But some of the things that we talk about may spark a question in your mind, so feel free to submit them. That's what we hope to do here, is to make it free-flowing and interactive. So a question that came in Our business has been heavily affected by inflation, specifically due to rapidly rising raw material costs. Are there any tax planning opportunities that we should consider given this change? And the short and quick answer is yes, absolutely. Obviously, inflation is something that everybody's dealing with. It's across the board, and just about anywhere you look, prices are up. How can you use this to your benefit? The first and most powerful solution is Lifo Inventory. Lifo Inventory is the last in, first out method of accounting for inventory. And when prices are rising, Lifo is at its most powerful. Now, a lot of people get scared when they hear Lifo, and we are here to put your mind at ease as it relates to Lifo. Lifo is not nearly as intimidating as some people think, and in fact, there have been some recent over the years. The IRS has actually made it a lot easier to elect Lifo and to calculate Lifo. I think one of the fears that people have had in the past is that administratively it's very difficult to calculate. And again, as I mentioned, a number of years ago, the IRS introduced what's called the IPIC, the Inventory Price Index Computation method of calculating Lifo. It made it a lot easier. It's based off a published index. You could still use internal methods, i.e. the old methods, but the IPIC method is something that has really simplified it and can give you some really powerful results. For instance, this year, Nick and I just this morning were on a call with a company who has never been on Lifo, and we have run some estimates for them, and it could be potentially around $500,000 savings this year, tax savings this year. And I have another instance earlier this year where potentially a $3.5 million Lifo benefit, which will equate to about probably in excess of $1 million of cash tax reduction. So that's hard dollars that the company will be keeping rather than paying the IRS. So that's just an example, a couple quick examples of area of how powerful Lifo could be. And there's certain sectors of the economy, the inflation we haven't seen it this high in years. So if you're not on Lifo, this is a year to definitely consider electing it. You can make that election up until the extended due date of your tax return, so it's not something that needs to be done right away. However, I also put this caveat out. If you are on Lifo currently and you are doing year-end tax projections, you really need to look at it and see what impact Lifo is going to have in 2021. For instance, I mentioned the couple of clients that we have already done that on. Those could have a huge impact on your year-end planning. And the other thing I want to point out, and this is somewhat of a negative, but some industries, some companies are seeing that are on Lifo are seeing big decreases in their inventory. Particularly, one of the areas that has really been affected by decreased inventory are auto dealerships. You've all heard about the global supply shortage. Auto dealerships have really been affected by this because of the computer chips. They can't get manufacturers can't get computer chips. They can't make cars. They can't get it to the dealerships. Dealerships' inventories are going to drop. So they may, even though prices have increased, some of those drops are so dramatic. If you've driven by any car lots lately, you'll see there's a handful of cars on a lot where it used to be packed. That could have a negative impact. I'm sure there's other industries that, because of the global supply chain issues, are going to see a huge decrease in inventories, and even despite the price increases, that could have what's called a Lifo Recapture. So it could bring some of that income that was deferred in prior years back into income this year. So Lifo, if you are going to elect Lifo, or if you are on Lifo, you really should look at that, what impact that's going to have prior to the end of the year, to help you with your year-end planning. Some of the I would say top candidates to elect Lifo in 2021, if you're not already on it: metals and metal products. Metals across the board are pretty much up in price. Chemicals, rubber and plastic products, processed foods, lumber and wood products. Those are just a handful of the industries that are really could really see an impact and a real savings due to the price increases in 2021. You know, that by no means is that list all inclusive. A number of industries can really benefit by electing Lifo, and it is something that everybody's affected by inflation, whether it's in prices that you're paying for inventory, prices you're paying for labor, prices that you're paying for gas. So this is a way that you could benefit by the price increases. So hopefully, like I said, if you are on Lifo and are reaping the benefits of it, we could still help you by looking at different methods. And if you are not on Lifo, we could certainly help to see if it does make sense to get you on Lifo to save some real cash tax dollars. So, okay, I want to move on to our next question.
Sure. Our next question is, in the past year, I started exporting more goods that we manufacture primarily to Mexico. How do I know if an IC disc is right for my business? Nick, do you want to take this one?
Oh, I would love to. An interest charge disc, IC disc. What is that exactly is an IC disc? It is an interest charge domestic international sales corporation. And why we would set something up like that is because we have a domestic manufacturer that ships their products overseas, or within North America, obviously, to Canada, Mexico. These types of incentives were put in place by Congress to get our domestic manufacturers a benefit if they are selling out of the country and adding to the overall trade surplus versus the trade deficit that many times that we in this country experience. How it really works is you basically will pay a commission to the interest charge disc based on the amount of sales that you have to a foreign country. That commission is calculated in various different manners, and you get to choose the best one that works out for the biggest tax benefit. You end up taking a deduction for the commission expense on your operating business. The interest charge disc does not pay tax on the commission income that it incurs. However, if you do defer for a period of time, there's what's called an interest charge, and it's basically the T-bill value on the deferred tax. Now, we don't usually advocate for deferral anyhow on an interest charge disc, but when the money comes out of the disc, the shareholders get to have it taxed as if it's a qualified dividend. So you would take a tax deduction at the ordinary rate, which right now is 37%, and you get to pay tax on that income at 23.8%. So there's a rate arbitrage there that is significant. Any products that are going overseas, or any products that we know are going overseas, even if we ship to a certain point in the U.S. and then we know they're going overseas, really may qualify. We have these discussions with clients that do exporting, And it's insane how many times that they're really underselling themselves regarding their foreign activity. Setting something up like this is not overly difficult. You really need a commission agreement, articles of incorporation for the interest charge disc, and a election that gets filed by with the IRS for the IC disc that will allow you to be treated in this manner. There's no extensions on the election, so if you're looking at doing something like this, make sure you involve your CPA or your tax planners so to make sure that those elections get filed timely. And also, we want to look at how we can maximize the commission. There's a couple of different ways that the commission can be calculated, and there's different ways that we can group products. So there are formal analyses that can be done to really leverage and take all the dollars off the table as far as how the commission is calculated. One of the quick and dirty ways that it's done is a 4% of gross sales commission. If you have a profit margin on your product that's less than 8%, a lot of times that 4% commission will be beneficial. There's also a way to calculate the commission based on 50% of the taxable income that you receive on the foreign sales. A lot of times, if you have a profit margin that's greater than 8%, that calculation can work better. Then we get into the more complicated ones that fall under the marginal costing systems and grouping systems, where formal studies could be necessary in order to take full advantage of those. But again, it's definitely worth looking into. The cost to set one of these up is probably under $5,000. Annually, the cost to administer something like this is usually around $3,000 just preparing tax returns. It's not anything that's overly expensive. We usually will have clients set up multiple bank accounts. Cash does need to move between the IC disc and the operating company. But we can help someone with all of that. I like to say that if you have gross sales of $1 million or more, we should be looking at an interest charge disc. If you have, and when I say $1 million of sales, $1 million of export sales. Because at that point in time, the rate arbitrages really start kicking in, depending on your profit margin. It could be less, it could be more that we need to have in place. These things are only going to get more valuable if the tax rates increase, which Donald will talk about in the Build Back Better plans. If the individual rates increase, the dividend rates stay the same, or the corporate income tax rates increase, this is a really nice planning mechanism and really one of the few export incentives that's in the tax code currently. So we have several clients that have these in place that have been utilizing them successfully for years. We have sample articles of incorporation, samples of commission agreements. We have attorneys that can help set these companies up, and we can assist in the calculation depending upon how complicated you want to get with it. We can help you go from the 4% all the way up to a complicated marginal costing with several different product groups. That being said, that's how you would know in a nutshell if it's beneficial to you. Again, feel free to contact us with any questions you might have on this particular structure, as we've done it many, many times.
Nick, I'll just jump in here. Something I just always like to point out to people is, when we talk about export sales, people always think of overseas. But really, especially in the last 10 years or so, selling to Mexico and Canada, those are considered export sales.
Yeah, for sure. And like I mentioned earlier, if we're shipping a product, and again, it depends on how much work is being done on the product at various locations in its supply chain position. If you're shipping somewhere like to Buffalo and you know that is going to Canada, that is can be considered a foreign sale.
Right.
If we're shipping to California and we know it's going to China, or we're shipping to Texas and we know it's going to Mexico, so on and so forth. So using that information and leveraging it to its full extent will help create a larger commission. The bigger commission, the bigger the rate arbitrage helps.
Great, thanks, Nick. Our next question, and we're going to send this one to you, Donald, is we expanded this year and built a new warehouse. Are there any tax planning options available for me due to the new property?
Thanks, Amy. Yeah, so anytime I see a client that's either building a new facility, expanding upon an old facility, creating additional improvements there of significant value, or they're buying a new property that's just new to them but is previously occupied by someone else, and the first thing I think of is performing a cost segregation study. What a cost segregation study is we'll consult with external firms here, and we will work with them, and they'll use their staff of engineers and accountants to kind of go through the blueprints and the invoices and everything built on the contract to determine what property is not considered part of the building and what we can consider personal property or improvement property. And the benefit here is anything that's capitalized as a building by default is going to be depreciated over 39 years for non-residential buildings. Anything we can calculate and determine that it's going to be either personal property or this qualified improvement property, we can depreciate that over either 5, 7, 10, or 15 years, depending on what kind of property that is. And then when we're looking at the benefit here, is then we can accelerate that depreciation. So, for example, if you have a building you're in construction right now, and let's say the cost we expect to be about $1 million, and the annual depreciation on that will be just over $25,000 a year for that full 39 years. But if we can capitalize even 10% as personal property, and we can take bonus depreciation on that, so the full $100,000 of personal property in the current year, and then the 39-year property left at $900,000, and that depreciation only decreases to $23,000 per year. So we can see it in the initial years. We get a giant benefit here. One, reducing our tax burden, so increasing cash flow for the business. This is mostly based on using bonus depreciation, and we have the options, and we have many clients that would prefer to expand that depreciation over its useful life. So maybe the 5, 7, 10-year property may run its useful life, and we'll take that depreciation over those years. But typically, the 15-year property or any of those longer lived assets, we want to take bonus depreciation on. And the biggest benefit here is, that cost alone typically pays for the cost of performing cost segregation study. So just to make sure that we're getting the most benefit we can and maximizing that cash flow, we want to make sure that we're at least covering the cost of the studies. Typically, they're pretty quick. But the one thing I want to make sure we talk about here is make sure we're involved anytime you're considering buying a new building or expanding, completing construction, because we won't be involved from the onset of the project. Kind of one of the worst things that can happen is we go to prepare the tax returns in late March, early April. We're trying to get the business returns done, personal returns done tied to that, and that's when we discover that there's a significant improvement done to the property, and then we want to perform a cost seg study. And when we have to do this, then it takes time. There's a lot of work involved, and so it may require the returns to be extended. So as long as you want to make sure we're hitting those filing deadlines for you, make sure we're involved early on so we can get those teams involved, and then we can maximize that benefit early.
One of the other things that has come up in the past, any buildings that have been previously purchased in previous tax years and a cost seg study wasn't done, you can go back and do a cost segregation study on?
Yeah, so even those old buildings that maybe we haven't done in the past, or maybe you're switching firms and your prior firm did not perform these, we can go back and these studies can be completed, and it's a little bit harder because we're looking backwards, but it's still possible. And part of this is we can file an amended change in or a change in method of accounting and go back and retroactively claim these deductions in the current year. So there's still benefit to be received, but I'm looking at it, I always like to get it as soon as possible, so we don't want to drag out and depreciate anything over 39 years that can be accelerated.
One of the other things that you could do regarding large additions or large renovation projects is what's called a prior year asset disposition. And if we do renovate large sections of buildings or tear something down or create a new asset, we can go back using price indexes and write off any remaining basis that may be on your books regarding those previous structures. And it's something that if you're faced with capitalization, you can not only have a cost segregation study done, but also potentially write off old undepreciated assets. And we always say to make sure you scrub your depreciation reports as thoroughly as possible to get rid of any of those types of things, just to guard against future sales and future depreciation recapture. But anytime you have any major renovation or construction project, there's a plethora of tax benefits that are out there that could help accelerate deductions and create additional cash flow through reduced taxes.
The cost segregation, I guess the simplest and easiest way to sum it up that I always tell people is a building has to be depreciated over 39 years. No bank is going to make you a 39-year loan. So the more of those costs that you can carve out and write off sooner, the bigger the benefit. And certainly the areas that we've seen over the years that seem to benefit the most from cost segregation studies, heavy manufacturing, even light manufacturing rank at the top of the list. So definitely an area for manufacturers to look at.
And the last thing I want to add here is throughout the study, a lot of these firms are really good, especially ones we work with, is that they'll also look for additional benefits. So when they're going through all these additions, they're looking for things that may qualify for energy tax credit. Perhaps you qualify for the rehabilitation tax credit. So in addition to those accelerated depreciation deductions, we're also looking for those tax credits that can also increase that initial cash flow.
Great. Before we go to our next question, we have our second polling question. Of the topics we talked about so far, which are you using? And we'll give you a moment to answer that question before we move forward. Okay, so let's move to our next panel question. In the past, you've talked about the R&D credit being available for manufacturers. How do we know whether this is an option worth exploring? Nick, do you want to take this one?
Yeah, fantastic. R&D is always a great credit that's out there. We've had some I would say controversy surrounding this credit recently. The IRS did place this credit on their Dirty Dozen list, which is a list that the IRS puts out every year on different tax items that they scrutinize. There's been some court cases where R&D studies were done that didn't contain the appropriate substantiation of the R&D activities, which has led to the IRS looking at these more thoroughly and changing the way that they process some of these credits. However, there's no reason why we should shy away from them because, again, we're going to do this right. We're going to substantiate it correctly, and I have no doubt in my mind that the credits that we could calculate with the help of the firms that we work with would not and have been upheld even in IRS challenges. The one thing that you need to be to know about R&D is it doesn't have to be a process that's brand new to the world in order for a manufacturer or other taxpayer to take advantage of the R&D credit. The R&D credit is here because Congress wants high-paying, innovative jobs to stay in the country. And they incentivize taxpayers that are learning new processes, that are technological in nature, that have uncertainty surrounding them, is to be done in the United States, to be done by those taxpayers, and for them to benefit from a credit for the expenses, the wage expense, the supply expense, the contract expenses that they incur in creating that research and development to better improve their products or processes. Anytime you are doing something where you have a high degree of uncertainty and the process that you're undergoing is technological in nature, you could qualify for this credit. And again, for a manufacturer, it's undoubted that you would have technological in nature associated with the process of research and development. You're using computers, you're using equipment to try to determine a specific outcome that is unknown and uncertain at the time. If you're using a third party to do these R&D studies, there's limitations on that, and limitations regarding who actually owns the research and development that's happening. So we could talk about that if that is the process that you're going through. But anytime that you have these processes going on in your plant, other than simply just deducting the costs, we could get a credit that usually works out between 8 and 10% of the expenses that you are incurring. Qualified expenses really have to do with the wages and the supplies that are consumed in the process. So again, if you have the ability to substantiate employees or owners that are performing these R&D activities, if you are able to substantiate and prove that you own the research, that you own the products, that you own the uncertainty, and all that risk lies with you, the credit is actually very, very valuable, especially with the tax rates where they're at. Again, if tax rates increase, the credits only become more and more valuable. And again, this is something that we can go back and look at credits in past tax years that may not have been taken. 3 years is the standard, but there's also ability to go back potentially even further than that. A lot of times startup companies that may not have had profits or did not have the ability to use the credits can go back even further. And we've seen this happen in a lot of different instances. The one thing that I will say is this year is big for R&D because there could be potentials in the Build Back Better plan and other tax legislation to change the way that the credit is calculated. So it could limit the benefit that is taken on it every year. There's been some delays in the implementation of that, but we want to make sure we take a look at the credit and get it calculated to the best of its ability. Small credits a lot of times can be calculated internally and substantiated internally with the help of us. Larger credits, we would enlist a firm to potentially do a study that would help document all of this stuff. And those firms will defend the credit to the Internal Revenue Service. So there's really no reason not to explore this. Anytime you have processes going on in your company where there are new things trying to be discovered, again, not new to the world, but new to you, we should try to take advantage of this credit. And I can't think of any manufacturer that wouldn't benefit to this to some degree.
And Nick, it's not just something. I always use the example: if you've been making pens for 50 years, and you're looking at a new way to make those same pens, that items like that qualify. I mean, that's an oversimplified. But it doesn't even have to be successful. You can try to make the pens in a new way, and you fail. And you go back. That's R&D.
Absolutely. And like I said, it doesn't have to be brand new to the world. It can just be changing processes or changing various things about your products. We have clients that have been in business for a century that still have R&D and new R&D every single year. So it's something if you're not currently looking at it, it's something that should be at least explored. You don't want to leave those dollars on the table because, again, it's an incentive by Congress to be innovative, and we should be taking advantage of it.
Great. Thanks, Nick. keeping along the same subject matter of the R&D credit, if we take a federal R&D credit, should we also be considering taking the state R&D credit?
Yes, absolutely. And again, we have clients that are in multiple states, so we'd have to determine where those activities are taking place. And the states have different ways to take the credits. Pennsylvania, for instance, you fill out some forms and you submit by the end of the year, and then PA kind of figures out everybody that's applying for credits and then gives you a number that you're allowed to take. And that would go against corporate net income tax or individual income tax. Ohio doesn't have a business income tax per se, but they have the commercial activities tax. So you can take Ohio research and development tax credits against the commercial activities tax. It's always a good idea to look at the state credits that are available to you, again, because that could be leaving extra dollars on the table. Again, it would change the amount of your state taxes that would be deductible, but again, the credits are worth more than deductions. So I would for sure say that those of us that are located in Ohio and Pennsylvania, there are lucrative state credits that are available for taxpayers that are undergoing R&D on the federal side.
Great. If we go to the next slide, we'll talk about our next question. Jim, we'll send this one to you. What is the cash basis of accounting? I've heard that this can be advantageous, but prefer the accrual method for my financial statements.
Okay. So yeah, the cash basis of accounting is, as it sounds, is your accounting is done on the cash basis. You recognize income when the cash is received for the most part, and you deduct expenses when the cash is paid, as opposed to the accrual method, where you recognize income when it's earned, and you recognize expenses when they are incurred. The cash basis of accounting is easy. It's a lot easier. It's a lot easier to manage. For the most part, it was generally unavailable to manufacturers. The reason being, anybody who had inventory was excluded from this up until the Tax Cuts and Jobs Act of 2017, which became effective in 2018. Now, anybody whose gross receipts on a 3-year average are below what's now $26 million, it started out at $25 million, qualifies for the cash basis of accounting. Could it be beneficial? Sure could be. If your receivables are generally higher than your payables, that is going to, that's a good indicator. Actually, just this morning, looked at a company who we made the election to switch for tax purposes to cash basis. That is about $150,000 of tax that they're going to save this year. It's not always, there are reasons why you would not elect the cash basis, but it's definitely something we look at every return that we do. Should we switch to the cash basis of accounting? And the key thing, and mentioned here in the question, you can stay on the accrual method for financial statements. This is a tax-only election, and it allows for planning, much better planning, because you're able to plan when you pay expenses, and obviously you can't plan when you get paid, but you can plan on when expenses are paid, and it could be a real benefit. So it is something that is available to manufacturers. Really wasn't in the past, and has been opened up. And if you're not on the cash basis and your average gross receipts are less than the $25, $26 million threshold, it's really something that hopefully we've looked at for you. And if not, let's talk about it. Let us know. And it could be a really powerful and simple change. And again, it doesn't change anything from on the internal accounting side. Just like in Lifo, a lot of people think that you have to change way you handle your records internally. This you don't. This is something that we would come up with when we do the tax return, and you would just reap the benefits and not really have to change anything in the way you do account for things internally.
Great, thanks, Jim. Before we go to our next question, we have another poll question. And like the last, this is very similar. Of the programs that Jim and Nick just spoke about, which are you using? Our last question today is about some new legislation. So, Donald, will Build Back Better provide any benefits to manufacturing companies?
Yes. So as we're looking at the Build Back Better bill that's currently proposed, and just a little update on it, and Congress or the House Representatives passed their version of the bill earlier last week. The Senate's kind of made some modifications to it and is currently in the process of debating it and making additional modifications. So kind of, as we talk about this, just a caveat that any of this could change. We're kind of expecting that some pieces will be either removed or put back on the bill kind of based on the original proposal. So kind of one benefit that I see definitely now for manufacturers as we're looking at what's still left in the bill is, as Nick mentioned earlier, there's been some potential changes coming for the R&D tax credit. The big thing here is currently for any tax year starting in 2022, we will be required to capitalize and amortize research and development expenditures over a 5-year period. So this will impact the amount of deduction. So currently, we're able to deduct those full expenses in addition to taking the credit. And having to spread that cost over 5 years will reduce our impact of taking the R&D study for the next 5-year period in time until all amortization catches up. We can get a full deduction for it. But based on the Build Back Better proposal as of now, this is slated to be pushed back until tax years beginning in 2026. So this could be another good benefit, and hopefully because this was originally pushed back from TICJA in 2017, and this will continue with the R&D trend where they continue to defer these updates and changes to it going forward. And probably the better benefit I see is the list of things that are no longer included with the bill. And back when Biden administration took over and proposed this bill, there was a lot of talk about increasing tax rates and removing tax benefits for those high income tax earners. So they're pretty adamant on taxpayers earning more than $400,000 a year would see additional tax increases. We'll kind of go through this list a little bit later. We have a couple slides on these, but as of now, there's almost no tax rate increases left on this bill as originally proposed.
I think if we move forward one slide, we'll see some of the information that Donald was talking about. This is the list of what's included in the bill. Donald, do you want to walk us through a few of these?
Yeah, so as we go through this list, we can see that most of these are kind of detriments. Kind of the big purpose of the Build Back Better bill was to kind of pay for all the other tax increases that benefit the general population. A lot of child tax credits, paying for schooling, stuff like that. That all has to get paid for somehow, and the plan was that they're kind of attacking those corporations and those higher income earners to help them pay what they consider their fair share. So the first one here is introducing what they call a corporate alternative minimum tax, and this would be a 15% minimum tax on corporations based on their financial statement earnings. The one big thing here is when they always talk about those high income earners, this would only be for businesses that report over $1 billion of net income on their financial statements over a 3 consecutive year period. This change would not be effective until 2023, so you're over that $1 billion threshold for a 3-year period, this will be impactful for you. Probably most of our client base this is not going to be an impact on, but if it is, we need to make sure we're watching out for that and comparing what our tax is based on normal federal tax rates and this potential alternative minimum tax. The next one is some modifications to GILTI, which is the Global Intangible Low Income Tax. And this is effectively, the Biden administration has worked with 136 other countries to kind of create a 15% minimum tax on corporations across the globe. So this is going to be reducing some of the deductions we're able to take when we're performing these GILTI calculations to create an effective tax rate of about 15.8% on the income of those foreign-controlled corporations. The next one here is going to be partnership abandonment and worthlessness. So anytime we determine a partnership is considered worthless, we will now have to consider what date that was considered worthless instead of assuming it's year-end, and then we'll be able to create a loss from the result of terminating that partnership. The Section 1202 amendments here, this is relating to small business stock. So currently there's up to a 75 or 100% deduction eligible for the sale of qualified small business stock. And this would only impact higher income earners. So the proposal is currently for any AGI over $400,000, you would not be able to take that 75 or 100% exclusion from that. So you'd be taxed on the full sale of that qualified business stock. We mentioned earlier the R&D credit. We may not have to amortize those expenses over 5 years. We can spread that, or take the current deduction as we incur those expenditures and take the credit. And that's looking to spend back to 2026. The application of net investment income tax on trader business income is going to be a huge impact on a lot of taxpayers. So any business owners that own their business through a flow-through entity, whether it's a partnership or S corp, currently there is no additional investment income tax on that. But under the current legislation as proposed, is that income would be subject to an additional 3.8% tax back through TICJA as well, where we introduced this bill on investment income. So this takes away a lot of tax planning we'd be able to do for S corps with maintaining ownership structures and pay schedules, as well as partnerships where we may have a management structure in place to bifurcate the active trader business from a more passive one. The limitation on excess business losses, this is currently in place now. This would just make that a permanent structure where excess business losses of over $500,000 would be disallowed and treated as NOLs to be carried forward. Originally, this is set to expire in 2026, but the Build Back Better program would make this a permanent feature of the tax law. The last one on here is the surcharge on high income individuals, estates, and trusts. So currently the proposal, this would charge an additional 5% surtax on any AGI exceeding $10 million for married filed joint taxpayers, $500,000 for married filed separate, and then $200,000 for estates and trusts. In addition to that potential 5% surtax on those taxpayers that are earning more than $25 million of AGI or $500,000 for estates and trusts would be subject to an additional 3% surtax. So here the current rates are 37%, and you have an additional 8% to get to a 45% effective tax rate on those top dollars. So, and this is scheduled to be effective starting for tax year 2022. So nothing as we wrap up planning for 2021, but something to definitely look at as we plan for 2022 and prepare those quarterly estimates. You can go to the next slide. The next slide here is going to talk about what's not in the bill. And as I mentioned earlier, the original bill from the Biden administration included a ton of tax increases on those higher income earners making more than $400,000. So originally there was a lot of debate going back and forth on increasing the corporate tax rate. Currently the tax rate is 21%. There was talk about moving it up to 28% or potentially up into the 35% rate. Currently that has been pulled back out. I think with an addition to the alternative minimum tax and other features we just talked about, and they believe they're going to achieve their revenue raising goals on those taxes. Next is to increase the individual income tax rate. So currently our highest tax bracket is 37%, but they were originally planning on increasing this back to 39.6%, which we saw under the Obama administration for those taxpayers making more than $400,000. That has been since removed, and there has not been any talk from the Senate from anything I've seen of bill. The increase to the capital gains rate was a large kind of tax rate we saw as an increase. This would be, originally it was in the initial draft of this, as for taxpayers earning over $1 million, the capital gains rate, which currently is capped at 20% for the long-term capital gains, would be eliminated for those taxpayers. So they would be potentially paying up to 37% tax on those gains. So we'd see almost a double tax rate on those gains. Fortunately, that has been since removed, and there's a lot of talk and a lot of planning as that bill was originally introduced to consider what we want to do for selling investments or different stocks, whether we want to trigger gain earlier to get locked in at the 20% maximum rate, or if we were going to wait and see if this went away. Fortunately, it did go away as of now, so we can put that behind us. This next one is there was a scheduled change to that 20% qualified business income deduction. Again, for taxpayers earning over $400,000, Congress's intention was to take this away so they couldn't benefit from that, but it's now left in there. The limitation of benefit on 1031 like-kind exchanges, same thing. We've seen this kind of been in the tax law changes quite recently, where they've limited this to the sale of real property is only eligible for like-kind exchange. But with the original Build Back Better program, there's additional discussion about disallowing this for higher income earners. And this last point here is change to the carried interest rules. This kind of the biggest impact here is on typically private equity groups is where we see this the most. And this is where we track that interest related to these investments, depending on a 3-year period, to determine how that's going to be taxed. But again, that has been removed from the bill, so there's no changes there to worry about as of now.
So what's I know everybody asks the question, what's the status? Where are we right now with the bill? It's sitting in the Senate?
Yeah, so Senate has created some modifications. I think it was Monday or Tuesday night this week. We saw some modifications come out for what they're planning. And probably shockingly, it's one of the few times we haven't seen many changes from the Senate. And oftentimes we see the Senate essentially rewrite the entire bill the way they want it written, and then it goes back to a joint committee to discuss between the House of Representatives and the Senate to determine a mutual bill to come back and vote upon. So now as we wait for the Senate to make their final modifications, we'll see how these steps progress and whether or not they're going to go back and vote on both House and Senate lines.
I did see this morning that Manchin was still concerned over the cost. So there's some debating that's going on there. You know, that's been what's been holding it up from passage. But you know, like you said, Donald, a lot of the stuff from a tax side of things has been mitigated anyway. So there's not a whole lot of major increases, but some of these other things that are in it still could have tax increases, even though the rates themselves aren't increasing.
Yeah, certainly, you know, it's gonna have an impact. I think we are all of the belief that what we thought we would likely see, it's a lot less than what we thought we would likely see.
Yeah.
Now that doesn't mean that something might take place next year, but I think the belief, at least from what I'm hearing and seeing from people, the belief is that in a midterm election year, there might not be a lot of desire to put forth any big tax increases. You know, not nearly as impactful as we were concerned, especially as it relates to estate planning. Mm-hmm. You know, generally, estate planning, trust and estate tax was left alone, and you know, that's something that we didn't mention. But for business owners, again, there's can't stress enough the importance of estate planning, and especially as we're going into 2022. We got a year reprieve because we thought a lot of these things would be changing in 2022, and it appears they're not. So if you need to brush up your estate planning, certainly speak to us. And I do think there are some opportunities that may not be available in the future. So, but thank you, Donald. Thank you, Nick. Thank you, Amy. Michelle, I don't know if we have any questions that have been. Oh, we have one more poll question. Build Back Better will benefit my manufacturing business. Agree or disagree? And while everybody's voting on that, excuse me, Michelle, I don't know if there's any questions that have come in during our time here.
Yes, we did get one that was submitted. Do you believe that the tax deadlines will be extended in 2022?
Do I believe? I think I'll offer my opinion, and I'll ask Donald and Nick to chime in. I don't think so. Barring something further getting worse with COVID like it is right now, I will tell you from a practitioner standpoint, it was sort of a welcome the last 2 years to extend it because it gave us a little bit more time. But right now, I don't see it. I don't know if you guys feel any differently.
I don't think it'll be extended again.
Yeah.
I think they're trying to get back to business as usual.
Yeah, I think that, again, unless things get dramatically worse with COVID, I don't see it.
Yeah, I agree. And I did see something where for the Kentucky disaster zone, they pushed that deadline back already.
Sure.
So maybe that's a good indication that they're not pushing everyone back. They're kind of really going back to focusing on disaster areas and those impacted directly.
Which is what we've typically seen in the past is hurricanes and blizzards and storms. Those areas, floods down in Texas last year, those get the extensions. But as far as a wholesale extension, probably unlikely.
I would agree.
Okay. Well, again, I thank everybody for their attendance today. If you have any questions, feel free to contact any of us. Our information's on there. Contact your HBK rep. We will be back again next year in January. In the meantime, I wish everybody a very happy holiday season, happy New Year, and hope to see you again next year. Thanks.